Good afternoon, everyone. Thank you for joining us for this finance webinar with Jos Milissen and Erik Kleerebezem. My name is Matthew Grison. I'll be your moderator and host tonight for this webinar. I see that we already have lots of people connected for our webinar, but let's wait a couple of minutes extra to give some room for people still stuck in traffic jam or something like that. And we'll start. It's 1 after 5. Let's start in 2-3 minutes. So if you still want to go grab a coffee or grab some water, you see that Erik is already ready to do his presentation, and but we'll be starting in a couple of minutes. And we see that already some people are active on the chat. So do not hesitate to make a good use of it. Good afternoon also, Sander, Gilmet, Lena, and Ralph. Feel free to ask all your questions in the chat. It will be the best way to move forward in the presentation. So the aim is to do the whole presentation in one piece and answer all your questions at the end of the webinar. So once again, please take time, fill it every single question you have, and we'll come back to it afterwards with Erik and Jos. And I see more and more people coming in and joining the session. That's great news. Hi, Ralph. So just 1 more minute and we'll be starting.
I'm almost getting nervous by what you're saying, Mathieu. If you say more and more people are joining.
Yeah, we have... Our team has done a great job, and I think that Jos is also joining us. He was. So let's get started. I think that some people will be able to catch up afterwards. So first important message for you all, feel free to take notes and anything that you would want, but know that this webinar is recorded and that we will be sending it to you. I think early next week, we'll be sending the link to you by email. So that you can be redirected to our website and see at will this free webinar hosted by Jos Milissen and Erik Kleerebezem. These are our 2 CFOs supporting Jefferson Wells rebranding today and giving some insights about some challenges they're working on at the moment. So I think Jos or Erik, which of you will be starting to present himself? I think it's you, Erik, or Jos.
Yeah, they say age before beauty. I started my career in the audit, like a lot of financial people at Deloitte, and that's already in my case a long time ago. After that, I worked for various companies, of which one was a UK company. After that, it was a Dutch company. And the last one before joining Manpower was a Belgian-owned company, and the last 2, the Dutch one and the Belgian ones, I worked in more in an international environment with sales offices throughout Europe and shops throughout Europe. I'm with Manpower by the end of this year already for 20 years. It's a long time. But nevertheless, I had a number of different experiences in those nearly 20 years, of which one was a 2-year mission in Frankfurt for Manpower Germany. And a bit later, I was the interim finance director for Manpower Austria in Vienna. And more recently, I've been responsible for IT, always besides my core business, finance, and I'm responsible for IT activities for 3 years. And now, since a good year, on top of the finance responsibility, I'm responsible for the administration of all our operations, all our branches. In my career, I had 2 passions that always came up front, and there was a strong focus on reporting, producing reporting that speak by itself and that lead to actions. The second one is I like digging into gross margin, and I can say that earned the company quite a number of euros because going deep dive in GP percentage is really something worth doing. And my newest passion is, now we're going to talk about it. It's about how we can link operational KPIs to financial performance. Up to you, Erik.
Yep. My background is a little bit different than yours, Jos. I've been only 6 months with Manpower, but before that, I've started my career in IT, working for Best Foods Unilever. Then, after a couple of years, moved into finance, becoming the European cash manager for the company, and after that, moved to Pepsi. Where I first was a program leader for a big reorganization program, and after that became a junior business controller, and then started my real career in finance. And then via several roles with bigger responsibility, moved to Ahold, which is a Dutch retailer, where I've done basically everything from reorganization to setting up new businesses, always in a financial role, but with a pretty broad responsibility. And after having worked there for like 7 years, I've been a private contractor working for Booking.com. I guess most people know that company, and Staples, for example. And then 6 months ago, I joined Manpower, and like Jos, also having a broad responsibility, not only for finance, but also for procurement and back office and mid office administration. And my passion, besides perhaps my work, is also cycling, because I think it's good to have a passion outside of your work as well. But I totally agree with Jos that looking for opportunities on how to improve the business, not only from a looking backward, but also looking forward, is certainly, that gives me energy. Also in looking for ways to improve the business as itself. And with the situation in the Netherlands, there's a lot of opportunity for me to fulfill that passion. With a lot of nice colleagues, I have to say. So if we can move to the next slide, I'll kick off the presentation. Because today what we'll be talking about is to move from strategy to results, and translate that in two ways, from initiatives to plans to budget, but also in the light of the changing role that we see also within Manpower of finance, and how do we combine that in KPIs? Not only KPIs that help us to explain what has happened, but primarily in KPIs that will help us to predict what needs to happen or what will happen. And so that's on the agenda, and then let's move to the next slide. Because today, I guess the key element is in how can we, as a finance department, add value, being a business partner in that way. And how can we use operational KPIs to translate into financial results? So that's the key topic of today, and hopefully we'll give you some pointers, some examples of our business in how we are doing that. But from my experience, and also I guess Jos's experience outside of Manpower, the funny thing is that what we're about to tell you today is in many ways also translatable in many other business types. So hopefully you'll leave today with some pointers, some examples that you can use in your own business. So can we? Yep. Because basically what we're talking about is the changing role of finance, and I guess that everybody knows that the base starts with recording transactions, and then explain what has happened, forecasting and predicting. And if you then look at what is happening in the financial world, you also see that there's sort of shift in added value from the top to the bottom of the slide. Because recording transactions is basically a commodity, and a commodity is usually under pressure from price or from cost that need to be saved. And in our world, and in other companies, it's not very different. I guess that everybody is read up on examples about, or is familiar with examples about offshoring, for example, to India, to low wage countries, of the base transactions that we're doing. In Manpower, it's absolutely no different. What we are also seeing, and there's a lot of literature already available on this, is that, and we're also making steps on this, is that we're translating this now to RPA. And the funny thing is that there are absolutely already some companies that are moving away from offshoring work to taking that back and translating that into RPA work. For example, in my previous life with Booking.com, we had something like 50 robots doing work for us, and that number is only increasing. So for that, that's basically the base of finance. Basically, that kind of work is slowly moving away, which means that we need to sort of move away from that and see how we can make progression to added value further down the value chain. Now, if you then look at what the sort of role of business control or financial control in many ways has been, is this sort of looking back in explaining what has already happened in the past. So explaining what has happened last week or last month, and providing that information to the stakeholders in or outside of the company. And of course, the other role of business control is forecasting. So making a plan, making a budget, and translating that into numbers. Which then, of course, the deviations to that plan are explained again in the monthly close or in the yearly close or quarterly close or whatever people might want to use in that process. Now, for today, we're sort of moving away from that and going to an area which we would like to call predicting results. And that's sort of for us the next stage in the evolvement of the finance role, and that is becoming a real business partner. So moving away from only reporting what has happened, or only reporting or putting into a budget what the business is doing, but also to help predict what will happen with the business. And I think we've got some nice examples on how we in Manpower are trying to grasp that. But again, these are examples that are applicable to Manpower, but I'm 100% sure that in whatever business you might be involved in, you can do exactly the same. If we can go to the next slide, please. So what we're doing today is we're making basically going from the cycle to define your strategy or define your plan in initiatives, in plans, in all sorts of things that you might want to do as steps to reach your goal or to define the strategy that you have, which as a finance person, of course, we'd like then to translate into a budget and a forecast. But today, what we're going to talk about is leading and lagging KPIs. And leading means is that you're doing something which then finally recorded as a result. And a financial result might be that you're recording sales. But what's the activities, for example, that you need to do prior to recording that sales transaction? Because in all companies, something is happening prior to recording the sales transaction, and then the GP and the costs that are associated to the sales transaction. And we're going to share some very, very nice examples, I think, about how to do that. Then go to the next slide, please. I think you'll take it from here, Jos.
Yes, thank you, Erik. That was a good introduction of what we are doing and trying to extend a little bit more than what we used to do in the past, which is the last block on diving into the KPIs. I'm gonna go through a bit more things in let's say in detail, a few examples of how this looks like in our companies. First of all, you start with a strategy. In our case, this is built by our head office in Milwaukee, so we don't have to invent anything, and that's something which is quite nicely explained in what we call a strategic playbook. So what we have to do in our countries is to translate that to our local situation and local markets. And then you do a number of things that probably all of you do, is look at the number of things you want to focus on, in our side, on the right-hand side, you have the demand side. For example, this could be focusing on logistics sector, on pharma, for example, because you get better margins. Could be on retail food, or could be non-food, because it's less fluctuating with the economy. On the left-hand side, you have the supply, and our side, the supply is actually a different kind of clients, which are our candidates, which is the workforce, and where you can focus, for example, on administrative employees because the margin is better, on IT profiles because a big demand for those, or students that gives you volume. Okay, then you look at things like market size and like sweet spots, places where you can focus on and get quickly results. You have a strategy on gross margin. You won't increase it, or you just sacrifice your gross margin in order to get more volume. You have to decide where you're going to invest. In our case, 70% of our costs are people, so invest this money in people. Where you're going to put them, where you can get the highest return, and you might target a number of key accounts. You put all this together, and then in order to get a certain financial target, which you capture in a financial budget, right? And then the connection between finance and the business might stop. So financial people, once you've got the budget, will continue to focus on the financial figures, and the commercial people do a number of things, but there's no connection between the two. And when everything turns out well, everybody's happy. But when it does not turn out well, and you don't
Jos, I don't know if it's me, but I do not have the noise anymore. Are you sure you didn't click on your mic?
Yes, but okay.
You're back.
Am I back?
You're back. I think we lost you when you were talking about the fact that when everything goes well,
okay,
everyone's happy, but that when it's not the case, there's something else that needs to happen.
Maybe it's a good thing to stop when everybody's happy. But what I was saying is that when the things don't turn out well, then you have discussions about it's the market, we lost a big client, or it's the economy, etc. And in order to keep the focus on a number of internal things, and to make sure that you have a connection between the financial budget and what the business is doing, we add a second additional line, which is the third block that Erik showed before. So we have added a number of, we created a number of initiatives, and further down, actions to realize these initiatives, so that you've got a number of things that will help you or give you a better guarantee that will reach your budget. And of course, in order to measure that, you need to define a number of KPIs, and we discuss later about those KPIs. I'm going to give you an example of what an action and initiative could be. The initiative in our case could be, we want to increase our market share by building a good sales plan in a particular number of predefined areas or segments. Below that, you have an action. First action is here, create specific sales plan, again with a segmentation as a target based on marketing data, and you're going to determine a number of prospects or clients you're going to work on. The objective is the same. You're going to try to increase, or you want to increase your market share in those particular segments. KPIs could be the number of sales visits and the number of calls. Action 2 could be prioritize a focus on a particular category of job orders, which for this case we call them A. Doesn't matter what it means, but you're going to put some focus on a certain particular thing. Again, the thing is here the objective is here to win market share and also increase your fill rate. Increase your fill rate. You do that by being better and quicker in filling job orders. In our business, it's quite important to be quick, because you're not the only one supplying the client. So speed is also important. Here, the KPIs could be CV sends, because the number of CVs you propose to your clients, and the number of interviews your client is willing to have based on the CVs he received, and that will then hopefully lead to starters. We have here starters per consultant because that brings also in a factor of productivity. So we have here KPIs, and as Erik already said before, we're going to divide those in leading and lagging KPIs. A leading KPI is a KPI that you start, and that should help you in getting results, which is then the lagging KPI. We'll get back to that afterwards. What's important is, what's important is that you have now a bridge on how you go from this year's sales to your next year budget. So it's not something we're going to do some extra sale. It's quite precise what you're going to do. You're going to focus a number of key accounts. You're going to increase your market share, and we've seen before in the initiatives and the actions on the previous slide what exactly that means. You're going to work on the number of job orders, and you're going to work on your fill rate. These are quite clear things which will be also supported by particular actions. On the next slide, I'm going to give a few more things on this. Here you have those lagging and leading KPIs, and I must say you need a good discussion to define exactly what these are going to be. And what we have quite a significant amount of initiatives and actions, so quite a bunch of KPIs. We have summarized and taken out a number of KPIs that are easy to capture, easy to measure, and also for which you can make a link to the financial performance. For example, we did not take in here the Net Promoter Score, which is a KPI that we have somewhere, because it's more difficult to connect that with financial KPIs. So it's very important to take out a number of KPIs because you cannot measure everything, right? And the objective is in fact, yes, that you have got a leading KPI, gives you a lagging KPI, and the final objective is that you get the financial performance out of it, which can be targeted sales. Can go you through a few examples here, what you can do with this, and how this helps you in predicting also future revenue or your forecast for the coming months. In this case, for example, we have the sales plan is the creation sales plan is coming back. The leading KPI is sales visits. The lagging KPI is the number of shop orders. For example, we have set for the first quarter 1,000 sales visits, which should lead to an increased number of shop orders compared to prior year of 2,000. Now, if you look at the end of the quarter, you see that you've got. I'm sorry, I'm going to bring you with me here. Too far. This one is the one I'm talking about. You see that you've got 1,050 sales visits, but unfortunately, you only get 1,900 extra job orders. So probably something is wrong with the conversion rate. So you can do two things, or you can see why the conversion rate is not good and work on that, or you can increase the number of sales visits in order to still get the 2,000. So this creates actions. This creates a discussion with the salespeople, and put the effectiveness of their sales actions in question, and that's the objective. The second one is the number of CV sends, the CVs you send to your clients, which might lead to placement. In this case, we're talking about permanent placement, so recruitment and selection. We define that we need 7,000 CVs sent to our clients in order to get 60 permanent placements, so 60 permanent placement fees. We see that if we did less than the 7,000, we did 6,178 in the red, and it's in red because it's below the target. Nevertheless, we reach our 60 sales or 60 permanent placement done. Now you could say, I'm happy, okay, because I realized my target. You also could say, or challenge the commercial people, what if you would have done the 7,000 CV sends? You lost an opportunity to do better than the budget. And the last one is where you have not done the number of CV sends. We're talking here not about permanent placement, about staffing, which means temporary workers put at work. And here the objective is to send 20,000 CVs, and that should you give 40 starters per consultant, right? You've done less CV sends, which results also in less starters per consultant. So here you need to revise as well. If you don't revise this, and this is a trend going on, then you might be sure that you are not going to realize your budget or your forecast. So you have to get a discussion with the commercial people. Say, yeah, guys, what are you going to do about this? Because otherwise we're not going to get the budget. As I said already before, instead of having to listen to arguments that is the economy or the market or something external, you keep the focus internal, and that's a major difference to what we had in the past. Right. What we then now doing is how you translate that into financial results. That's the next step, and this is very, very important here, because we're making now really the bridge to sales. Getting back to the sales calls, and we also have here sales visits attached to it. Okay. In January, you see we have foreseen 2,100 sales calls and 525 sales visits. What you see straight away, you only have done 200 sales visits on the right-hand column in the actuals. Of course, Corona plays a role in here. I'm sorry, I have to put on next. Corona plays a role. You see the 200 on the right-hand side, the second line of figures, sales calls and sales visits. Because of Corona, we did less sales visits. Fortunately, we compensated that by doing more sales calls. But nevertheless, we had the objective to realize 1,181 orders, new orders in January. We only received 1,100. I hope you can follow me. The orders are in the January forecast, 1,181, somewhere in the middle, job orders received. And on the right-hand side, we only did 1,100. And the conversion rate is not 45%, but only 40.74%. This probably has to do with the fact that the sales calls are less efficient than the sales visits. So there's something you can question about that. What are you going to do? Are you going to try nevertheless increase the percentage? Or are you going to do more sales calls to compensate for it? Or maybe you can discuss, instead of sales calls, you might do video calls, something new that you could argue, because maybe video call is better than just a sales call, where you only have a voice. If you go further down to this, you should have had 5,181 vacancies and new job orders completed, while you only have done 5,100 because the 81 you're missing from above are not there. The fill rate is a bit less, 24% instead of the aim 25%. But what's happening is the number of job orders filled is, because of this, is lower. You aim to have 1,295 and you only have 1,224. Of course, you look at the green line, you are not realizing the sales revenue of 6,476,000. You only have 4,120,000. If you don't react on that, what's going to happen? This is going to continue, and you're going to be month after month, you're going to have the same result. So now you're going to discuss with commercial people, particularly if you look at what you're going to forecast for the next months. Something has to happen. Or you're going to work on volume, or you're going to work on success rate. But the powerful thing of this is that you start having a real discussion about things with the commercial people, which we didn't have before, and that makes a big difference. What's important also on this one is that I'm going back a flip a moment. This one, which results in the financial performance, but this one is something which is brought on the table in our monthly management meetings since a couple of months, and that really creates good discussions about how you're going to work on forward. You're not only discussing about euros, you're also discussing about how you get to those euros and what you have to do in order to take corrective actions. So that's very important. I want to bring you a bit further into details, because we also want to have, the previous one is something you discuss after month end, but sometimes, well, not sometimes, you're losing a number of weeks there. What we have created is what we call a KPI tree. A KPI tree on a number of things. The most obvious one is the tree of all the actions you do in sales, and Erik is going to talk a few minutes about that one. You also have another one. As I said before, we have two kind of clients. We've got our real clients, and we got our candidates. Our candidates, which is our delivery part. In other business, that could be production, that could be planning for consultants or whatever. So everybody's got a kind of supply part. The KPI tree here, we didn't start from the beginning, because didn't get on the page. So before that, you also have a number. You also have KPIs on the number of candidates you get in, on pre-screening of candidates, on the interviews, internal interviews we do. But you end up then with a short list, where you see on the left-hand side the orange kind of thing there. Okay, what's the objective then further? You have the candidates. The objective is that you do CV sends to clients, because you have to propose those candidates to clients. You get on further down to the right. Also important is how many of these candidates can you send to clients. It's also a kind of conversion percentage. Those CV sends then have to go. The next step is that the client selects a number of those CVs and see the candidates. So there's also conversion rate. If you send them good candidates, the conversion rate will be higher, and your clients will be more happy than if you send a lot and they only can find a few of them. Of those candidates that the client has seen, you're going to have a number that will be given an offer. So that's the success rate of the candidates that have been interviewed by the client. And those candidates then must accept the offer. Now, that's generally pretty high, but you still might lose a few percentages, because they have a second job order they might choose for another client, or for another company. All right, what we also bring in here is the people that are at work already the previous weeks, because we have missions that are of a shorter period. So you'll also have what we call some stoppers. So you take the candidates working for you minus stoppers plus the additional ones, and that gives you candidates that you put at work, and that will give you sales. Some of you might have seen a thing like that, which is called a depot scheme. But in this case, we didn't look at it because this is purely built with common sense, by sitting together with your operational teams, and by getting that cascade on paper and digging into all of the steps that are there. It's important. It's very important to understand this very well, and what you do here is, and you'll see in a few slides, we go further and into sales. We have a lot of discussion about KPIs in the past, but never until the link with sales, and that was the one that we really wanted to realize. This is something which is followed up on a weekly basis. You can react pretty quickly. Something what's important is when you start working on this, you might be discouraged quite quickly in the beginning, because you will see that some of this information is not readily available, or that the data is of poor quality. And you all know the principle shit in, shit out, and that's how we started. So it doesn't look like something valuable. But what you do then is, what we did at least, we showed what we got, even if it was scrap, to the people, start comparing, start benchmarking, and you see that a number of things are good. And what we noticed in just a few weeks, this thing was self-corrective, because people were confronted with very strange things, for example, that the conversion rate was not good, or that the profitability was not good, or the productivity, I mean. So this was self-corrective quite quickly, And we came in a few weeks to something that makes sense. So that's very important, not to let you discourage when you start with this. So I hand over to you, Erik, to explain a bit on the more common KPI tree for the commercial side.
Yeah, thank you for that, Jos. Without going into too much detail in the KPI tree itself, I think just to get back on a couple of points that Jos already mentioned. Because the example that Jos gave about the DuPont analysis tree is basically applicable, I guess, in all businesses. And what Jos and his team have done is translated that kind of thinking into how can we steer the business into a level of granularity that helps us to not only see what has happened, which is sort of the outcome of something, but what is leading to that outcome. And that's the powerful thing of this whole setup, because then you can connect the financial world to the commercial world and even to the operational world, I would say. Because also here, if you look at this tree, it's pretty common sense. It's the job orders that you get in new, the job orders that you're losing, and thus the net effect that you'll have in the business. What's I guess the most fundamental thing, also flipping back one or two slides in the story of Jos, is that you start to get a feeling of what the conversion rates are. Because just to get an example, in the Netherlands we have a business. I'm not giving you any names, but we have a business which is not so successful. Basically, because of two things. One is we do not have enough insight in what the operational performance is of the salespersons, or what the performance is of the people that are getting in new orders from clients, or the number of calls that they're making to get those clients to get the new orders. That kind of information is insufficiently available, thus we cannot measure the success. And we have one other business, which is an IT company, which is hugely successful. And there we know per person, per week, even per day, the number of calls they're making, the number of orders that they're creating with this, the number of proposals that they're sending, the conversion rate from proposals to offers to clients, the GP that is being scored per offer. We know this from the top down, the total company down to the person who's making the calls, and every conversion step, because if you go from the left to right in this industry, every time you're making a conversion from one layer to another, we know pretty damn well which conversion rates are applicable to each step. And that company is really growing like hell. And they're basically using, perhaps inadmittedly, they're using this scheme as a base for their success. And what we're now having to do is to make sure that we roll out that kind of way of working, I would say, through all branches of our companies. Because we have, in the Netherlands, we have something like 7-8 companies, some pretty small, some very big. But everybody's using a different way of measuring their operational KPIs. And what we want to do is to use the same set of KPIs as much as possible for all the companies, to measure the success from the lowest possible level to the highest possible level and every step in between. Because that will help us to not only record the sales, but also predict. Because if we do a sales call, then that sales call in a number of days or weeks will finally translate into fulfillment, which will then lead to an invoice being sent, or in other words, revenue being recorded. So it will help us to make the step from only recording transactions to analysis of results, to to predicting the result that will come in the coming days, coming weeks, even coming months. Because that's how far we can look at this moment using this kind of analysis. Then getting to the next slide, like I said, this basically helps us translate everything from the sales operations part to the candidate part into the sales objective that we have put together. Getting back to one of the first slides, the sales objectives that we have put together together with the commercial people into our plan. So we can, to lowest granularity, we can follow the success level in the end, resulting in a financial result. And that's how we match the operations, commercial activities together with the financial activities, helping us to add more value to the finance role that we have, and also making it, I guess, a lot more fun because now we're suddenly heavily involved in how to run the business instead of how to explain what has already happened. I hope I'm translating that correctly, Jos, also into your experience.
Yes, that's perfect, Erik. I just would then like to go to the last slide, which explains where I was saying, if you want to go to this, and this is no rocket science. This is there's no fancy consulting slides here with a lot of theory. It's just built out of practice. And I just wanted to give you a few key success factors that you have to bear in mind if you want to do this to make you succeed. First of all is to understand. You must have controllers that really have, want to go into details, that connect with commercial people. By the way, the 3 controllers that have been working on it are quite recent in our company, and they all were hired via Jefferson Wells. So just a small side note. But you have to sit together with them. You have to take time with them. You have to try to understand how this works and ask a lot of questions. Otherwise, it will not work. That's the first thing. As I said before, you won't get reliable figures straight from day one. So you have to you have to accept that the first things you get out of there are not really looking good and might be a bit shitty, but by insisting on it and by trying to build anyway something out of it and confronting the commercial people or the operation people with it, you quite quickly get to something reasonable. So that's an important one. And then of course cooperation is also key. If you do this just with the idea of controlling what are operational and commercial people are doing, you won't get there. You need to assist them, and quite quickly. Also, when you're talking about or working on the reliability of figures, there's a lot of interaction, and they explain to you how the business works, but you have to explain them after. For example, things like conversion rate, and so by looking and comparing things. So it's getting already interactive while you're trying to build reliable figures. But it's important to they must feel that you're helping them, because if they realize their targets, the companies realize the targets, they might get better bonus. So it's a win-win situation, and it will include as a part, yes, a number of challenging things you do, and by asking questions, that's what we do. Asking questions less aggressive than say that something is not something is wrong. So that's quite important. I think that's it from our side. I maybe did go into a bit too much detail with the figures, but I wanted just to explain how it works, and that part is the new part for us. So I wanted to stress on that one. So if you've got questions, fire away.
Thank you, Jos and Erik. We already have one question from Johan regarding the moment you were presenting leading and lagging KPI. Johan is asking if it's a one-on-one relationship or not. I don't know which one of you is interested in answering this question.
I can take that one. No, you can have several actions that lead to the same leading KPI. You can have a marketing campaign that helps you. You can have sales visit that helps you. For example, you've got already, which in my presentation you saw, you've got sales visits is one KPI, and sales calls is a second KPI that both lead to getting in new job orders. You have the same thing as well on the other side. You can have one leading KPI which gives you, let's say, sales orders, but also something else which can help, for example, in increasing the conversion rate. So it is not one-on-one, and you can have several initiatives that lead to several leading KPIs, several lengths. So you can also have a leading KPI which is connected to a lagging KPI. You can have that lagging KPI again being a leading KPI for something which comes afterwards. So a number of things. It's quite dynamic. That but it's important you get a connection and then you can influence it.
Exactly, Jos, and I think that the most simple way to explain it is via the tree that we have shown. That you can have multiple indicators that finally result in one result, and I guess this KPI tree will be different per type of company. I guess the tree that we've just shown is pretty similar to the industry that we are working in, which is the staffing industry. But if you do this, for example, for the logistics company, you'll have a different tree. But the funny thing is that that once you sit down with the commercial people, the operational people, and you start thrashing out this tree with them, then also referring back to the previous slide, then you also get to a point where you start to get joint ownership of the final result. And in my experience, that has often been a point of discussion, or often been a point of frustration. To be honest, from my side, is that finance is somehow responsible for the numbers, and there's often discussion about those numbers. But if you start using mechanics like this, then almost automatically there is joint ownership of what is being recorded. So this sort of, I would say, bycatch of this whole exercise.
And this is a perfect link to the question of Patrick. Erik, thank you for the easy transition for me, as Patrick is asking how to reduce or track data inaccuracy in the tree. So you were talking about joint responsibility. Is it the beginning of answer for Patrick?
Yeah, I guess so, because what Jos also was referring to, this is not an exact science. DuPont analysis is exact science. You follow the DuPont scheme, and it's basically either division, multiple, or addition, and you get to exactly the next stage in the DuPont tree. Here, it's often going into a modus of trying to get to ratios which help you predict the next phase. That like we used the word conversion ratio. It's not every month or every week that you have the same conversion ratio between number of calls and finally leading to a request from a customer. But if you look at things on a longer term, then that conversion ratio suddenly turns out to be pretty good predictor for if you make 100 calls 1 month, then that will lead to 3 offers in the next month. And that's sort of experience ratio that you need to build in.
Yeah, the inaccuracy, if you want to have this in 100 accurate, you'll never start off. And you don't need that to provoke discussions. What I often use when I get discussion about that, I start comparing. I start doing internal benchmarking. You compare to their colleagues, and you always find things that are better. So that will avoid the discussion of inaccuracy. You see a kind of trend, and I in the past, I must say, it stopped me also that if things were not 100% accurate, I blocked. But this is no longer the case, and you don't need that to provoke a discussion. So just comparing, asking questions, and you'll discover things, and your commercial colleagues or operations will discover things, and you start working on that. You cannot find all the solutions, so you got a few things. Start working at that, and then you just see where it leads you to. So don't let you stop by the fact that the things are not 100% correct. Otherwise, you won't get anywhere.
Yeah, but I guess the magic word here that you're using, Jos, is benchmarking.
Yeah.
Because what you'll find out is that, for example, one region might do twice the number of calls with the same number of people as another region. And then the question is, okay, how come? And another question might be, hey, the conversion ratio between this person is completely different than a conversion ratio from another person. So the quality of calls or the quality of visits is also something to take into account. Which leads to a question: how can we improve the quality level of the other person?
Yeah.
So this is giving a lot of also operational insights and ways to improve processes between departments and also people.
Maybe a tip I can give, which I use quite a lot, is when I do benchmarking. You can set a target. What I said, I use often what I call a floating target. The floating target is the average of what your company, well, in our case, the cost centers are doing. So the floating target is the average. And what you do then, you start working on, the people that are below the target, because nobody likes to be below. They're working at it, and so they're getting better. But by doing that, your floating target, your floating average is increasing as well. And that's how you can use benchmarking in a way, to improve the whole thing.
Thanks a lot for your answers, both of you. The next question is coming from Joachim, who asking the following: is how can business control support operations, and who is responsible for these metrics and KPIs tree?
Well, it's a good question. I would say in the end, for me, it's always the general manager who is responsible. And Joachim is the general manager. That's why I'm giving this answer, of course. No, but in all seriousness, I think in the end, it's Joachim who's responsible for the end result. But to get to that end result, for me, is very much a joint effort. I am together with the general manager of the Netherlands responsible for the total results of the Netherlands. I would expect that the business controller of Jefferson Wells in the Netherlands feels jointly responsible for the end result, which also means helping to determine for Joachim how to steer the business and how to set priorities. Because you cannot change the world in one go. You need to focus on those things that sort of help you make baby steps forward, and to like Jos is explaining, to change those elements in the KPI tree that give you the best effect. And like I said before, in the end, it's a joint cooperation between the business and finance that makes this successful. Because that also leads to joint ownership of the end result.
Thank you, Erik. Perfect. Nothing to add.
Okay. So I'd say that for those questions, like Joachim is mentioning, joint efforts and trial and error are keywords, and willing to improve the situation. I'm checking in the chat. We have a proposal from Pratik saying that he could need a webinar on floating benchmark. So that might be an idea for us for next webinar. Thanks a lot, Patrick. Would you agree, Justin, Erik, building something on this? Is it something which we have expertise? Maybe just to give a teaser to Patrick.
I don't think you can fill a webinar just on floating targets. It's just something very, very simple, which we started doing. And when we were discussing up in Manpower Belgium, we're discussing about productivity. We had a productivity ratio which we call the GP per staff per day, which we created some time ago, and we had discussed what should be the target, and we started to stay up that we want to get better. So let's take the average on that, and we created two categories: the one that were just below and above, the one which were really above, and the ones which were below. And what we see is, the ones that were below, they hated to be on the third slide. They wanted to move to the middle slide, and really this is not a joke. And so we have been discussing with those how could they get better, but by getting better, target is moving up, and so it kept going, and it's not more complex than that. And really the guys on the high end, they were challenged because the target was getting up anyway by the ones that didn't want to be in the third slide. So, and particularly salespeople, they don't like to be they want to be the best. So, and that works very well.
Yeah,
absolutely.
In the example, and again, I don't think it's fair to mention any names, but in the example I was talking about, the IT company, they make the results of their operational KPIs, they make them transparent for the whole company. So everybody in the company knows who the top performers are in sales and who the bottom performers are in sales. And believe me, nobody wants to be at the bottom part. So everybody's trying his best or her best to make sure that they're making the calls and they're making the getting to the leads and the fulfillment on those leads.
Okay, thanks a lot. I see that no new questions coming from the chat. So if you have, if anyone has an extra question, now is the right moment. In between, I already want to thank you both, Erik and Jos, for sharing with us all those learnings and tips and tricks and how the journey was for Manpower Group in Belgium, Netherlands, about building those decision tree and how finance can become a finance 2.0, 3.0, depending on how you want to name it, but becoming even more a partner for the business and starting to be predictive instead of just reporting about the past. Thanks a lot. I see already people thanking us, so I think we're good. Again, we have some good idea maybe for the future, so we'll catch up with everyone. This has been recorded. Everyone will receive the videos in the coming days. And should you have any more question, or should you have as a company more interest in how we build that, just give us a sign by replying the email we'll be sending, and we'll be more than pleased to get in touch with you and see how we can help. Once again, thanks you everyone who participating, followed, and Jos and Erik for your participation today.
I think I'm speaking for Jos as well. It was a pleasure to do this, and of course also for the Jefferson Wells team to invite us. And apparently, Jos, in your case, Jefferson Wells has helped you to hire some pretty good people as well.
Yes, I'm quite happy. These are the ones that these. They're people that they're not that long on board. They are 6 and 9 months on board, and they jumped quickly on this kind of things. And in 9 months we made a big progress, and the last 3-4 months was really a number of efforts that made a difference. So I'm quite happy with that. So thanks also for listening. And if you got more questions, I'm sure you can contact us via our Jefferson Wells people. If you want to speak with us, even to discuss a few things in detail, or particularly on the floating benchmark stuff, feel free.
Okay.
Thank you. Have a good evening, everyone.
Bye.
Have a nice day.
Bye.